Of course, I should put this background in while I'm down here in Kauai. Now, this isn't the real thing, but the view out my window isn't that much different. Anyway, it's Sunday night, and it's time to talk about what's going to be happening this week in finance and with regard to Tesla. I might do another one tomorrow night, uh, updating whatever financial information that we have going into the week, because, of course, today's Memorial Day and the markets are closed. So may do that, may not do that, haven't decided, but we'll see what happens. Okay, let's this is Randy Kirk. If you like this content that I do every Sunday night, please also hit subscribe and notify if you'd like to be notified about very, very cool stuff coming up this week. And then there's always Patreon. You could support the channel by joining Patreon, information down below. All right, let's take a quick look here. We get home prices. Now, the street doesn't even have an opinion on what's going to happen with home prices, but I bet if you follow this channel, you can guess what I'm going to say. I suspect that prices are up. I think they'll be up, maybe even, well, maybe it's showing already, maybe it's not. But I have a little cheat thing that I do too. I'm not just going off of the national stats and what Redfin is saying and what Zillow is saying, but I do look at those things. But I also took a look at 3 or 4 other examples, and all 3 examples that I looked at were up 1.5% in the last 30 days. So yes, the market is, the prices are increasing on housing. Don't know if that's true in every single market. Don't know if it's true in your market, but I can tell you what's happening in Southern California, and generally speaking, you can kind of extrapolate to the rest of the country based on that. And that's also what the news is coming out of Redfin and Zillow as well. So that's what's happening? Well, I have been saying for a long time now, there's no inventory. And I don't care what the interest rates get to. Well, there's always a limit, but I've been in interest rate environments where mortgages were over 10% and people are still buying homes. So right now we're sitting at around 5, 5.5, 6, depending on what you do. Those numbers are nationally, those are averages over the last 100 years. So no, I don't think mortgages are getting in the way of people buying homes. High prices apparently aren't either, because the prices are going up. So that's what I would expect to see on Tuesday with pricing, house pricing. But it may be lagging a little bit. I might be more ahead of those numbers. All right, the Fed isn't going to like that. Obviously they're not going to like that housing prices are going to go up, but as I just kind of mentioned, them continuing to raise interest rates is not really going to kill the housing market, because the thing that's going to kill the housing market is kill the pricing increases would be lots of inventory. That's just not going to happen. It's not going to happen this year. It's not going to happen in 2 years. It's not going to happen in 5 years, because there's a big missing piece going on in housing. I've had many clients over the last 15, 16 years that are in real estate and in mortgage. And I can tell you that I've studied it backwards, forwards, and inside out. And what's happening is home manufacturers cannot afford to buy manufacture affordable housing, because the permitting and all of the nonsense from the local regional governments costs just the same or about the same on a $250,000 house as it does on $1 million house. So which one are you going to build? You're going to build the luxury housing. That's what's getting built. That is part of Hawaii. Roosters everywhere, hens and roosters, but there's chickens everywhere. I don't know if you knew that. If you haven't been to Kauai, the island is overrun. There was just an article in Atlantic the other day talking about the island is overrun with these chickens. And there's, again, regional government. You can't do anything about them. You can't kill them. You can't shoot them. You just have to live with them. Anyway, but what's happening with housing? It's not going to change anytime soon. Old folks like me are staying in their homes. Even if they move out of their homes, they're renting them out. They're passing them to their children through their wills and trusts. The shortage is not going to go away until regional and local governments figure out that they need to help manufacturers by lowering some of these costs of starting a home, of getting a house started, to where they can afford to build homes in the lower price ranges. The second thing we're going to get on Tuesday is the Consumer Confidence Index. It's expected to show a drop when it prints on Tuesday. Consumers seem very worried about inflation, even though the headlines are probably the reason for that right now. Everything that I'm seeing, Trueflation, other evidence would be that the two main things that consumers look at and judge inflation by, the regular purchases of food and drinks in the grocery store and the price of gas at the pump. Both of those have moderated. They're down. They're either even or down or going up very slowly. And so the consumer should be able to see this. They should be able to, they generally will start recognizing that this is taking place. But the inflation headlines are still everywhere, and they will be everywhere this week. Consumers might be concerned. They're probably also concerned with the Fed trying to knock the economy to its knees, even though they're all employed. And probably not seeing any evidence around them that jobs are going away or people are being laid off because the layoff numbers are insignificant. So not 100% sure, but the street thinks consumer confidence will be down. And of course, the Fed would like that. Wednesday will be the beginning of the employment numbers for the week. And so first you have on Wednesday, the ADP numbers. They can look very different from what we're going to see on Friday from the Labor Department. Now, the street looks at ADP numbers as kind of a hint. They don't take it hugely seriously unless it's a real big surprise. So don't look for a lot of change in market prices or stock prices on Wednesday, even if this is higher or lower than expected, because basically the street is expecting only 180,000 new jobs from ADP, down from almost 300,000 last month. That'd be a massive jump or drop in just one month. So I think that 180,000 is not going to be the number. I think it'll be higher than that. And even 180,000 wouldn't be low enough for the Fed to be going, okay, it's working. We're going into a recession. Now, the drop from 300 to 180 might look like that, but 180,000 would still be a decent month. So we'll talk about this more in a minute when we talk about the Friday numbers. The same day that we get the job openings, the street is actually schizoid because the job opening numbers are coming out on Wednesday also, and the street thinks that is not going to reduce at all. Well, it's going to go from 9.6 to 9.5 million jobs available to the 1 million people who are seeking those jobs. So we still have a 9-to-1 ratio. It was as high as 11, but it hasn't come down hardly at all. So why would the street be thinking that the new jobs being filled would drop off a cliff at the same time that the new job opening or the job openings would stay almost unchanged? Now, there is a couple of headlines recently. I don't know that these are great reports. I'm not sure that I totally buy them. But there's some indication that a lot of the larger companies have some ghost openings or some, this number might be a little higher than it really should be, because apparently some people are applying for jobs that they're totally qualified for. And it turns out that, well, maybe they're not going to fill that job right now. I'm not sure about any of this. All I can tell you is at a 9-to-1 ratio, I've said this before, you've heard me say it if you watch this channel, a 9-to-1 ratio is historically nutso. So, I mean, it's normally, there's usually more people looking for jobs than there are job openings. We have 9 job openings, 9 jobs out there for every one person that's looking. That's not a recession. There's no way to get a recession out of that. And we'll keep talking about that. Anyway, so then the one thing that could cause a recession, that's M2, the money supply. Again, if you follow the channel, you know that's my biggest concern. That's Kathy Wood's biggest concern. If money dries up, the job situation could change overnight. If money dries up, businesses will go out of business so fast it'll make your head spin. Every company that is not prepared for that kind of a problem is, going to go out of business within months, not even years, but sometimes even within weeks. If the banks don't have any money and if consumers can't borrow money, it dries up fast. We have been through this story. We've seen this movie. It's not good. This is not the way. I don't think the Fed wants to kill the economy this way. They shouldn't, because it is devastating compared to other ways that you can go into a recession or create a recessionary circumstance. But right now, M2 continues to fall. Gary Black says the other day, it has not fallen this fast for 50 years. So continue to watch this M2 situation. Kathy Wood talks about it every week. And of course, Friday night, coming up this Friday night, Kathy will be doing her monthly review. And on Saturday morning, I will review what Kathy said on Friday night. On Thursday, we're going to see the purchasing managers indexes for construction and for manufacturing. The street is looking for manufacturing to continue to show contraction and for construction to be up slightly, 1%. I'm not, both of those numbers would be good from the Fed's point of view. I don't have a number for you. I don't have a sense of where each of these are going other than what the street might be looking at. We'll see what happens. Okay, then Friday, that's the big one. The rest of the week, it's very hard to see any of the rest of these numbers really causing anything outsized in the market. But the employment numbers, the consensus right now is 188,000 jobs added compared to 250,000 last month. It's almost kind of like the numbers that we saw with ADP. The unemployment rate at 3.5 compared to 3.4, so only moving up fractionally. Hourly wages up 0.3% from 0.5% last month. That might be okay with the Fed, especially the drop from 0.5 to 0.3. That is maybe in line. That'd be 3.6 per year. That's a little higher than the Fed would like it. They'd like it at 3%. So that would need a 0.25 monthly increase. But I don't think this will scare the Fed. If it truly is 0.3, I think they might think that's okay. And that might be the one number they need to see to allow them to skip a price increase on June 16th. So anyway, wages don't seem to be a problem. I mean, they are and they aren't. I don't hear a lot of noise out there about the wage increases hurting business right now. It seems odd with a complete, with this 3.4%, 3.5% unemployment rate, and with 9 jobs for every person seeking it, you would think that that would be causing an acceleration. I'm not sure why not. I can't quite explain it. There's a lot of stuff going on. It's really kind of hard to explain with regard to these numbers, but it does not spell recession, except for money supply. All right. So I would say that if I look at all of those different analyses by the street, by the consensus, how they pull that together, this week's numbers all look to me like hopium. Now I know, I'm sure they're going out and they're asking their friends and their associates and their groups and finding all the data that they can and pulling all that data together to get these numbers. But it looks to me like more like hopium. I think that the number of jobs added will be higher. I think that the unemployment rate will not go up to 3.5. It probably won't go down. I mean, it's really, really hard to get under 3.4%. It takes everything being perfect. The 3.4, 3.5 range is kind of like people changing jobs, people looking for a better job and changing, or wanting to go back and live in a neighborhood that they love or whatever. So it's really hard to get under this 3.5. You can see states sometimes or cities that get down to 2.5, 2.4, where there's a huge concentration of service jobs. But this 3.5 nationally is really hard to get under that. Okay. Let's look at Tesla for a minute. Well, Tesla right now is buoyed up with tons of good news, and all of the noise, all the unnecessary, all the bad news stuff, all the things that were causing people to be concerned about Tesla or be anxious in any way about Tesla, those have all gone away. And then there's all this massive good news. I'll be talking about more of that in tomorrow morning's weekend news report. the news is really good at Tesla right now, and the bad news has gone away. So this is buoying up the stock, and in a different market, Tesla would already be at 400. I know, you think I'm nuts. No, in a good market, Tesla would already be at 400. In this market, I think this could be the week we break 200. I've seen a number of technical analysts. I've seen a number of folks who watch it very carefully, who agree with this, that this could be the week we break back over 200 and start heading to that tougher neighborhood in that 214 to 217 area. That'll be a much harder bar to clear than the 200, even though 200 being an even number, a round number, that's always a hard one to get past. But the 214, 217 is really the number I see as being a really difficult one to get past. Now, the fundamentals are there. The risk adjusted value of Tesla, it should be way over 217. It should be way over 250. It should be at 300 plus, even in this market. But it's probably going to take a long time. It's going to be slow like this. It's just going to continue up, because it doesn't have any reason to be held down anymore, except market. I mean, the market could have a really bad day. Obviously, the market is very happy with the Fed's figuring out the credit cap and raising that. It looks like it's going to go through Congress. So that's good news. And so the market is poised to continue, maybe I'm saying flat at the beginning of the week, and then maybe going up towards the end of the week, and we'll see what the job numbers do. Okay, I think that wraps everything that I wanted to talk to you about today. If this was useful, of course, like it, subscribe, hit notify. I see that I have a lot more people coming in based on notifications. So that notification thing is helping you. Hit notify, and then if you want to support the channel, that's Patreon is the way to do that. Randy Kirk here. It's been great talking to you.